But there's a very interesting deal in the chemical space as well. Aarti Industries and Deepak Fertilizers, and the agreement is on nitric acid. Sonal is here to tell us more. Sonal, hi, good morning.
Good morning, Prashant. Well, first the news, and as you rightly pointed out, it is between Aarti Industries and Deepak Fertilizers. It is a 20-year contract, a term sheet that these two companies have entered into, where Deepak Fertilizers will be supplying nitric acid to Aarti Industries, and term sheet is expected to be executed by end of this calendar year itself, that is 2022, and also the size of the contract is 8,000 crore rupees. Now, what does this mean for these two companies? For Aarti Industries, nitric acid is a big raw material, and for Deepak Fertilizers, it's one of their major products as well. In fact, Aarti Industries, in the last conversation that we had with them, told us that they are planning to set up a nitric acid plant, this in order to secure their supply side arrangements, and because nitric acid availability was not very strong, and because of the Russia crisis, prices of nitric acid had gone through the roof. Now this means that they will be able to secure supply of nitric acid, their backward integration plans that we need to know about. But for now, it is a positive for Aarti Industries because their supply side needs are taken care of, because they had been indicating that nitric acid availability is not at par with the previous levels.
Okay, all right. Thanks a lot for that, Sonal. Well, I'm looking at RHI Magnesita. Well, over the weekend, they went ahead and they bought the non-core business of Dalmia Bharat. That's a refractory business out there. So they've gone for market share, but it's come at a price. Let's run you through the details. They are going to be issuing shares of close to around 27 million shares at a price of around 632. So the equity consideration will be around 1,700 crores. Add to that, they're taking on debt of around 450 crores. So approximately, it's around a 2,150 to around 2,200 crore enterprise value. And this is coming for a company that they're acquiring whose EBITDA for the last year was little less than 100 crores. So it's coming at an expensive valuation of around 22 times EV upon EBITDA. However, they're going for market share. So that's where we're going with green on this one. We'll hear from the management later on in the show as well. But Sonia, Escorts, why are we tracking that today?
So there was a midterm business plan that Escorts came out with on Friday post-market hours. And I think the stock is going to react positively. And the street might like it because there's some very aggressive guidance that the company has given out here. They talk about how the revenues will grow more than 2.5 times by FY28 over FY22. And their EBITDA margins from 10.8% in FY22 are expected to improve to mid-teens. They are looking to attain leadership in the India led by in the export business of India in terms of tractors, and even in the domestic tractor industry, they are looking at becoming a challenging brand versus a market share of 10.8% that they had in FY22. Now, how will all of these objectives be met? That will be met by expanding their capacity. So they're looking to expand capacity from 170,000 units all the way to 300,000 units, and the total capex that they have outlined is about 4,000 crores. Now, JP Morgan maintains an underweight. They say that they are very encouraged by the company's roadmap, but the stock has perhaps priced all of this in because the stock is now trading at 25 times FY24, and the strong growth, the good news looks like is in the price.
All right, Sonia, thanks very much for that. So that's Escorts for you. Now, Pharma is going to be in focus. Ekta is here to tell us more. Why? Ekta, hi, good morning.
Thanks for that. Well, yes, definitely a little bit of bad news coming in for Aurobindo Pharma because their Unit 9 has been inspected by the US FDA and issued 10 observations by the US FDA already. Remember that this particular plant already had an official action indicated status, which is basically a negative status from the US FDA, increases the chances of any kind of regulatory action, which was issued in May 2019. After that, this was the first inspection, we understand, and then they were issued 10 observations. So it doesn't bode well. We don't know what the observations are. The company said they're procedural. They do not relate to data integrity. But nonetheless, we could see a negative sentiment on Aurobindo.
Okay. All right. Thanks for that, Ekta. Hopping across to Rima. Rima, you're tracking Cyient?
Well, they held an analyst meet on Friday where the company provided insights on their strategy, business outlook, as well as the new growth area. In terms of numbers, the company reiterated their ambition of hitting $1 billion of revenue by FY24. It should happen in the second half of the year. They also reiterated their FY23 guidance, which stands at 13 to 14% in organic growth, plus an additional 14 to 15% in terms of acquisitions in constant currency terms. So they reiterated their guidance for FY23. But they also provided a lot of commentary on the new growth areas, particularly auto, healthcare. Now, these currently are about $15 to $30 million in size. But they're saying that in the next couple of years, these individual verticals can hit $100 billion. They also spoke a lot about the communications business, which according to them can actually get up to $250 million by FY24, and there will be a lot of acquisitions that the company will take in order for these verticals to grow in size. There was also an important update about one of their businesses, DLM. If you remember, the company had been guiding that, we want to monetize it in some form, part divestment, a part partnership perhaps, maybe even an IPO. All the company said in the conference call is that some updates should happen, some concrete plan should happen by the end of this fiscal year. Back to you.
All right, Rima, thank you very much for that. More stocks with news flow. Vivek is here with that. Vivek, hi, good morning.
Well, good morning. A whole host of stocks in focus on the back of multiple changes as far as the indices are concerned. First on the list, of course, is the sensex change. So Tata Motors will come into the sensex effective December 18th at the expense of Dr. Reddy. Tata Motors is expected to see inflows of close to $150 million, while Dr. Reddy is expected to see outflows of close to $112 million. When you're talking about the FTSE, like we had indicated last week, Delivery has made an entry into the FTSE. This will be effective from December 16, 2022. Inflows of close to $8 million are expected into Delivery. Also keep in mind the lock-in period, the 6-month lock-in period for Delivery shares as far as Anchor Allotties ends today. So the stock will remain in focus on the back of that as well. Another update, this is a finalization of an earlier paper drafted by the NSE. The NSE had earlier, invited applications in terms of how exactly are participants expecting NSE to treat corporates or treat companies in indices on the back of corporate actions like mergers and acquisitions. So the NSE has now decided that the new rules indicate that the target will be deleted from the index 1 day prior to the X date. Now this, taken in context of the HDFC Bank merger, basically indicates that HDFC will now be deleted only 1 day prior to the X date, and the weight will be increased the next day.
All right, thanks a lot for that. So here's a quick recap in case you missed out on any of these stocks. Stocks with positive news flow. There are all the iron and steel stocks. There's Tata Steel, JSW Steel, JSPL, SAIL, NMDC, Aarti Industries, Deepak Fertilizers, RHI, Magnesita, Escort, Cyient, Tata Motors and Delivery, while stocks with negative news flow, Aurobindo Pharma and Dr. Reddy's Laboratories. But the big global headline is what's been happening in the world of crude. There's a massive slide that we've seen. There are demand concerns resuming once again. Of course, bodes well for oil importers like India. But Manisha Gupta is here to give us a quick roundup of what led to this steep fall in crude overnight. Manisha, over to you.
Thank you for that, Sonia. Well, yes, 10% of a decline in the previous week is what crude is dealing with, and we are trading at a 2-month lows right now. It has to do with the surge in COVID cases in China, and China also cutting not just the November deliveries, but the December loading volumes as well. So that tells you that the demand is not improving in the world's biggest importer there. The Europe supply concerns also seem to be easing as refiners are now have piled up stocks. And the markets also are looking at weak economic data continuing, not just from China, but the U.S. manufacturing activity in the month of October also was the lowest since 2011. So it is about increasing production from U.S., weak demand from not just Europe, but China as well, and enough supplies that the Europe is dealing with right now, all of that weighing on the chart.
Right. Thanks very much. Oil, of course, is a big positive for macros. Markets, though, in the short term, is that a cue that maybe demand is weakening faster than expected? And what's the rub-off? That one will have to wait and watch. But on the macros, unarguably, it's a positive. We'll take a quick break here. Up next, Ashish Kejriwal of Nuvama Wealth Management will join us to talk about